Tax-efficient equity investing, solutions for maximizing after-tax returns is what we're going to talk about here today. A study from Vanguard. This might be a few years old, but the same thing is applicable just as much today as it was a few years back. In fact, it's probably even worse today because we've had such a bull market in stock. So we're going to talk about here today. If you know me, you know I love Vanguard. This research they do is just first rate. Let me turn this light on so you get a better... There we go. Look at that. So you can see both sides, not look so creepy. Don't want to look creepy or else people won't watch the video. So, all right, let's dive right into this. Welcome to Heritage Wealth Planning YouTube channel, my friends. The place you come to learn about tax-efficient equity investing. So remember, what is equity? That's stocks. Equity equals stocks, all right? So bonds are not stocks. So we're not going to talk about bonds here today. You know what I'm feeling about bonds, especially in taxable accounts. Don't do that. But we'll talk about tax-efficient bond investing at some other point, maybe. We'll see. But for right now, we're just going to talk about stocks. So remember, equities and stocks, they mean the same thing. So if anyone ever says, I'm getting equity market, they're just talking about stock market. It's that simple. All right, so let's dive right into this. Don't forget to subscribe. All right, so subscribe down below and get into this. I think you'll get a lot out of this, actually. So I want to start right here. Introduction. Over the long term, tax-wary investors have learned one sure thing: the tax code is never static. Nearly every year, new legislation is considered or enacted by Congress. The wealth you realize today and tomorrow is dependent on both current and future tax and income rates. Yet, who can foresee those rates in 20 or 30 years from now, or even 10 years? Recent tax law changes include the 2003 cut in the maximum tax rates on qualified dividends and capital gains have heightened interest in tax-efficient investing. Again, I think this is a few years back, but stay tuned, because all this is still just as meaningful today as it was in 2008 or 9 or 10 when they wrote this. In fact, like I said, it's probably more. Manage your portfolio with taxes in mind. Managing the allocations of your portfolio over the long haul is much more important than managing exclusively for taxes. However, awareness of tax efficiency is integral to managing a portfolio. Vanguard research has shown that of all the expenses investors pay, tax can potentially take the biggest hit out of total returns. I'm just telling you, that's a fact. Most mutual fund managers are not concerned with the tax implications of their trading. One reason is that as a commingled vehicle, a mutual fund most likely has a mix of both taxable and tax-deferred accounts, IRA, 401k. Therefore, trades focused on tax efficiency may not benefit all the investors. Historically, listen to this, domestic stock funds, about 2 percentage points have been lost to taxes. 2 percentage points. This tax cost represents approximately 20% reduction in the equity market's total return of 10.4%. 2 percentage points. You're getting 10, you're losing 2. That's a 20% reduction, my friends, in your net return. And net return is all that matters. I could care less what your gross return. I care about net return. That's a big deal. All right, so let's keep going down. Thus, it pays for investors to be more sensitive to taxes. Yep. So we're going to go down this right here. All right. So this right here, portfolio strategy and tax efficiency. We're going to talk about this here in just a second. I think my guy Joel, so if I go Control Plus, oh yeah, look at that. Joel from Florida. Used to be from Massachusetts. Look at that. Fantastic. All right. We're going to read this first, and we're going to come back and show you what it means. An index is a group of securities designed to represent a broad market or a portion of the broad market. An index is intended to tell investors what has occurred in a particular market in order to provide a benchmark for performance. By definition, since indexes are designed to reflect the performance of a market, they are constructed to be market cap weighted. An index investment strategy such as conventional index mutual fund or ETF aims to track the performance of that index or a sampling of that securities in that index, like the Vanguard Total Stock Market, that compose the index. Indexes use quantitative risk control techniques to replicate the benchmark return with minimal expected tracking error, or I will say also trading too, and with no expected alpha or excess returns versus the benchmark. So they're not trying to beat the benchmark, they're just trying to track it. In fact, the best index isn't necessarily the one that provides the highest return, but the one that most accurately reflects the performance of its what I was trying to track. So basically, you have two indexes. I have a 99.9% tracking success rate. You have an 80% tracking success rate. I'm going to beat you than you because I'm going to be a true barometer of the index. Well, I might not beat you, but it's certainly not an index fund. If you have a tracking error way below your benchmark, you're just not an index fund for sure. So we're trying to get as minimal expected tracking error. It's called tracking error. Error than as possible, which Vanguard, iShares, all those guys do that. Fidelity, Schwab. And there will be no expected alpha or excess return. Now, that's fine. That's where people say, I want alpha. I want excess returns. Well, let's talk about this. Figure 1 shows that 75% of index funds with the lowest tax cost each had a lower annual tax cost. Figure 1 shows that 75% of index funds with the lowest tax costs each had a lower annual tax cost for the 15 years ending 2007 than 75% of actively managed funds with the highest tax cost over the same period. The figure shows an 83 basis point differential in median tax cost. So here's the median, 1.9%, how much you lost U.S. stock funds tax cost. The medians, 50% above, 50% below, lost almost 2% to taxes. The median, that's just it, 50% above, 50% below. Look at that. The median for the index funds is 1%. So basically 50% lower is the median. All right. Now, this doesn't stop there. The figure, that's an 83% differential, 1.9 versus 1.07. Tax cost represents a very high hurdle for active managers to overcome in addition to management expenses. Some index funds can be tax inefficient. Yeah, we know that. Much more broadly, I want to show you this right here. Watch this. Here, now this is the 75th percentile, all right, for index funds in terms of their tax loss. So the 75th percentile is equal to the 25th percentile for active managed funds. So the 25th percentile is 1.49 or less. The 75th percentile for index funds is 1.41 or less, which means inherently just rolling the dice, the vast majority of index funds are going to have much, much less loss to taxes than the vast majority of actively managed funds. It's crazy. Just look at that. Never mind the median, just look at the 75th percentile. 75 out of 100 funds have less tax loss than 25 out of 100 funds for the active managers. It's crazy. Again, we're not talking small potatoes. If the median is 1.9 and the average market was up 10.4, you're losing 20% of your return to taxes. And that's before fees, my friends. All right, so I want to go over here to show you something about ETFs right here. We talked a lot about ETFs, so let's talk about these right here. Just as there are structural differences between conventional index mutual funds and ETFs, there are structural differences between ETFs. For instance, Vanguard ETFs are organized as separate. Oh, yeah, right here. This is what I want to talk about. Okay, I just want to scratch that. I want to talk about this. Tax efficiency is another touted benefit of ETFs. Where have we heard that before? Oh, yeah, I did 3 episodes on that using the Right Capital software. Tax efficiency is another touted benefit of ETFs, owing to the ability of all ETFs to manage capital gains through in-kind redemptions. Unlike some cash redemptions, in-kind redemptions do not generate capital gains for tax purposes. Moreover, in-kind redemptions can actually reduce embedded capital gains because they allow a fund manager to push out the fund's lowest cost share loss. As this process continues, more of the fund's portfolio is composed of higher cost shares. This tax-sensitive accounting technique is also available to conventional index funds. Some comparable tax management strategies are available to both conventional index funds and ETFs, regardless of structure. The tax efficiency of like products should be similar. So let's go back to table 1. Which is this right here. All right, so here's table 1. Tax efficiency of selected broad market index funds and tax managed funds. 5-year annual tax costs from September 2 to 2000, from December 2002 to December 2007. The Vanguard Index 500 Admiral shares, which is I think 10,000 minimum, you only lost 31 basis points of 5-year annual tax cost. The iShares lost 32 basis points. So look at that. You lost literally 1/3 of 1% to taxes. And this is during a nice run up too from 2002 to 2007. Broad market index is total stock. You lost 28 basis points. iShares 27, and Russell 1000, the largest 1,000 companies, lost 22 basis points. It's just, you can't. you just can't shake a stick at that. The active mutual fund, again, the median was 1.9. All right, let's keep going down. And Gus Sauter used to run all these funds. That's funny. I knew that. I didn't know him, but he didn't know me, but I met him one time. All right, so this is what's interesting too. Trading strategy, broad market index versus actively managed funds. So we've established that ETFs have an inherent tax advantage over most mutual funds because they can do in-kind distributions as opposed to selling things which generate capital gains, because all income distributions, capital gains, and dividends have to be sent to the shareholder. Broad market index funds continually buy and sell securities based on changes in their market indices. Since purchases and sales of stock positions within an index fund occur only to adjust for the relative size of the positions within the index, large concentrated purchases and complete liquidations of entire positions are less frequent. All right, hang on. That's a lot going on there. It is critically important to understand why this is huge. Every day when there's a positive net cash flow into a broad market index fund, the manager makes small fractional purchases of every security within the index. On the other hand, when there is negative net cash flow out of the fund, the manager makes small fractional sales of the securities. An index fund's transaction pattern generally means that over time, this is huge right here, the fund accumulates a large number of share lots with wide dispersion between the low and high cost. All right, I got to read that again because that is critical. An index mutual fund's transaction pattern generally means that over time, the fund accumulates a large number of share lots with wide dispersion between the low and high cost. Use of tax-sensitive accounting, HIFO, high in, first out, highest in, first out, or specific identification accounting of share lots. Where have we heard that before? Oh yeah, old Josh, which is why you pay me the big bucks to go and subscribe to this YouTube channel. So HIFO, or specific identification, in combination with this wide dispersion of share loss, can be effective in limiting capital gain distributions resulting from fund redemptions. I cannot stress this enough how critical that is. This type of transaction pattern differs from the approach of a typical active manager. Based on a belief in a security's potential to outperform, an active manager is more inclined to make specific, concentrated purchases and fewer equities and to liquidate entire holdings more often than would a manager broad index fund. Therefore, actively managed funds tend to have share lots that are much more concentrated in portfolio names and less dispersed in purchase prices when the sale of an individual portfolio positions is needed. I'll explain all this in a second. Active managers typically do not make small marginal sales of many individual positions, but will tend to completely eliminate certain holdings that may have lower return expectations relative to the rest of the portfolio. In making wholesale liquidations, active managers are much more likely to realize capital gains. Since the entire position sale would be realized, HIFO accounting plays a minimal role. That's huge. It's huge. So basically, you're saying you have all these different positions, 100 shares there, 22 shares there, 85,000 million shares there, 2 shares here. Some have way high cost basis, some have way low cost basis. I can pick these from HIFO, highest in, first out, which will minimize my capital gain, or I can specifically identify of these thousands of shares I bought, thousands of transactions I made each day. I'm going to sell that sucker to eliminate taxes when I sell that sucker. It's in mutual and actively managed funds, because they're usually taking concentrated positions. They don't do that. They don't have the ability to go pick, because all they have is one huge lot of transactions that can buy 2 million shares today. 2 million shares can be executed at 1722, 1723, 1721. It just is not that much dispersion. So it's concentrated perspective. There's a concentrated buying, or essentially buying of the security with a very, very concentrated price point that they're getting. They're going to get some at 1721, some at 1720. But when Vanguard does it, for instance, they're buying at 1720. The next day might be 1826. The next day might be 1620. They can specifically identify what shares to purchase and or to sell to offset the capital gains. And here we got transaction pattern differences, which is pretty good. Now we talk about HIFO. I'm not really going to get into this. They do give an example of HIFO, highest in, first out, for selling lots, and you can actually see how the identification of HIFO, highest in, first out, can reduce capital gains for sure. So I do like this tax cost comparison of selected Vanguard funds, and we're looking at 10-year returns, total stock index. as expense ratio of 15 bips, tax cost of 44 bips. So between those two, you're looking at 60 basis points is costing you from the total return of the benchmark. So the benchmark gives you 10, you're only losing 60, right about 60 basis points. You're getting 9.4. All right, so you're losing that's 0.6 of 1%. Compared to 20% the other way with an actively managed fund. And that's before expenses, by the way. It's just as crazy. 15 basis points here, 22. That's a capital appreciation fund, which is tax managed, but is capital. That's capital opportunity. Is that an actively managed fund? I don't know. But anyway, still, look at that. I mean, you're talking 37 basis points lost to fees and taxes. Tax efficiency and competitive pre-tax returns can go together. With stock funds, the size of the fund's distribution affects its tax efficiency, but the type of distributions also plays a big role. The 2003 tax law changes. The difference between tax rates levied on long and short-term capital gains grew wider than it's been in years. Let's see. Most investors now pay 15% on qualified stock dividends and longer-term capital gains over 1 year. However, the tax rate on short capital gains can be higher as to ordinary income. As we've shown, broad market ETFs and mutual funds are generally tax efficient because they don't generate a high level of capital gains, short or long. Actively managed funds have historically generated a much larger amount of capital gain distributions. And they talk about same thing after. Oh, I like this right here. Pre and after-tax percentile ranking of Vanguard funds within Morningstar. Look, I'm not telling you to go buy Vanguard. I'm just telling you at the end of the day, you'd be awful hard to beat by Vanguard. You can never, well, I'll say you never go wrong, but like Med Faber says, you're never going to get fired for holding Vanguard. All right, so here's 5 year. Pre-tax, they're in the 31%, they're the 31% performance. So 30% of the funds did better than them for pre-tax returns. 69% of the funds did worse. But after tax, 24% of the funds did better, or 23% of the funds, and the rest did worse. And then we go here, the International Stock Index Fund. Pre-tax, 18% of the funds did better, whatever that is roughly. After tax, only 13%. I mean, it's just, you can see here, tax managed small cap. We got the growth in income, 37% did better. After tax, 28% did better, and the list goes on and on. Controlling costs does make a difference. Contrary to the typical economic relationship between price and value, higher costs do not lead to higher returns. Every dollar paid for management fee, trading costs, and taxes is a dollar or less of potential returns. Unlike market performance and the other elements that determine an investor's return, however, costs are more predictable and controllable. Research has repeatedly shown a powerful relationship between low costs and relatively high returns. On Table 6 provides evidence for the inverse relationship between investment performance and costs. So let's find Table 6. That's on page 10 right here. All right, so here, Morningstar category quartile rankings by expense ratio. So the median expense ratio, 0.69. The median return is 5.92. Large cap funds, median expense ratio is 1.02. The median return is 6.07. And you can see the higher the cost, and just, other than this right here, everything else flows nicely. Small cap, mid caps. And so here you got the median expense ratio, 0.91, median returns 9.93. You go down to the next one, the higher expense ratio, lower returns. Other than this one right here, everything falls into place like that. We have the lowest expense ratio, the highest expense ratio, and by far the lowest returns. Look at that, over 6.68 versus 8.69. That's 25 basis point, 25%. You're losing a quarter return to fees right there. And again, I think that's even before taxes. I'm sure it is. So look at that. That's crazy man talk. So again, lower expenses, high returns without any else being consideration. Then you look at taxes as well. It's just undebatable. I do want to show one other thing here. Misconception. I find this pretty funny. Misconception. Large capital gains will be realized during a market sell-off. As growing index mutual funds tendency to create a wide dispersion of share loss in each security is a powerful defense against the risk that such portfolios will become the tax traps that critics claim them to be. A common misconception is that a fund manager will be forced to sell holdings because investors will tend to redeem their shares during bear markets. At the height of the late 1990s, bull market equities, Vanguard broad market index, and tax-managed equity funds maintain large unrealized capital gains. The funds perform very well The funds still perform very well on an after-tax basis, distributing very low to no capital gains throughout 2007, even though from 2001 and 2 we had huge sell-offs, 9% in 2000, 11% in 2001, and 22% in 2002, even going to the beginning of 2003. Table 7 shows that in the event of a market decline, the funds were in a position to redeem substantial portions of fund assets before realizing any capital gains. Even in a flat equity market, many of the funds could liquidate a sizable percentage of fund assets before realizing capital gains. So here was this table. That's figure 2. Where's table 7? Table 7 right here. All right. So basically, I mean, this is pretty confusing, but unrealized, they just didn't realize that much because they could specifically identify which shares to sell. And they had so many lots because every day they're buying, selling here, buying, selling, buying. They can pick out those lots to sell, which can offset capital gain distributions for sure. And then going back, the fund performed, I would say, so well on an after-tax basis, distributing very low to no capital gains through 2007. That's after the bear market during the bull market of the late 90s, the bear market of the early 2000s. So that's it, my friends. Lots of great research by Vanguard. Average annual capital gain distributions of index funds. All right, so here, look at this. So the average capital gain distributions of index funds as a percent of their asset value. So basically, if you have $100 roughly, they've been distributing was about $1.25 of capital gain in 1993. And that's in 2000, they distributed $4. In 2002, they distributed 50 cents. And in 2007, they distributed $3. That's incredibly low. I'm telling you, I use this story all the time. Had a lady had $200,000 at American Century Mutual Funds, 2 funds. Fund went down in 2015, I think, 14, 15, one of those years. And she got hit with a $40,000 capital gain tax nonetheless because it distributed 20% of its capital gains because they had new fund managers come in and sell everything and buy new stuff. It's horrific. She was not a happy camper. Now, she bought it. It had nothing to do with me because she just said, but that's where you have actively managed funds. When they change managers, look out because that new manager is going to go in there and tear it up. And if you don't believe me, just look at the history of Fidelity Magellan. Maybe I'll go and do a video on that too at some point. All right, my friends. So if you like what you see here, you're interested in tax reduction strategies, man, this is the place for you. So subscribe, thumbs up, comment, go to Heritage Wealth. I'm on Facebook too. Some YouTube folks do go to Facebook. So Heritage Wealth Planning, just type in Heritage Wealth Planning on Facebook and you'll see it. Don't forget to go to the blog at heritagewealthplanning.com as well. And I look forward to seeing you next time. Thanks, guys.